What's a house's favorite outfit to wear? Well, an ad dress. Okay, today I'm going to cover my top tax write-offs for real estate agents and brokers for 2022. Now, these deductions are often overlooked and underutilized by real estate agents across the United States. And because of that, successful real estate agents almost always dread tax season because they are likely going to see a huge tax bill and have to reach into their savings to pay the IRS. But I want to help you change that today because real estate agents have a plethora of tax deductions at their fingertips that they can use to reduce their tax liability and build more wealth. So in this video, I'm going to break down how real estate agents receive income, a unique tax strategy with calculations for real estate agents, and my top tax deductions that you need to pay attention to. And if you stick to the end, I have one bonus strategy for you as well. So if that all sounds good to you, then make sure you like this video while the intro plays. Hey there, and welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. If you're excited about this topic or you know any real estate agents that can benefit from watching this video, please make sure you share this with them because they'll definitely appreciate you for it. All right, let's go ahead and dive in and quickly explain, number one, how is income reported for real estate agents? So many real estate agents are considered to be self-employed or independent contractors because even though they legally have a broker that represents them, they handle everything else from signing clients to closing deals, and they do all the work on their own terms, conditions, and schedule. Whereas W-2 workers are employees which are working accordingly to their employer's needs and schedule. Anyway, so real estate agents are independent contractors, so they usually receive what is called a 1099 miscellaneous form or a 1099 net compensation form at the end of the year. This form reports how much total earnings a real estate agent received, which are usually from paid commissions from the sale of a home. But the big thing to note here is that commissions are not net, they are gross. So it does not take into account all the expenses and qualified deductions involved with selling homes. So it is critical, especially for successful real estate agents, to keep track of all their expenses so that they can deduct them during tax time. All right, so let's go ahead and talk about one of the biggest tax benefits for real estate agents in 2022, which is number two, real estate rental property losses. One of the most unique tax benefits of being a real estate agent is being able to take rental property losses against your active income, like your real estate commissions. Okay, let me explain. So normally when people invest in real estate, they can take advantage of one of the best tax deductions, at least in my opinion, which is depreciation. Because depreciation is one of the few tax deductions that can show a loss on paper even if you had positive cash flow. So let's say, for example, that you bought a real estate property for $100,000 and then you made $16,000 in rental income. So your year one revenue is $16,000. But then you also have direct expenses like your mortgage, your property taxes, maintenance, repairs, and all that totals up to be $6,000, which means you made $10,000 in cash flow before depreciation. But thanks to the depreciation of your house, you're able to get a $25,000 tax deduction, which will now show that you lost $15,000. So instead of having to pay taxes on $10,000 of cash flow, you won't have to pay any taxes at all now because of depreciation, which is pretty awesome, right? But in this scenario, you still have a $15,000 tax deduction left over. So what happens to that? Well, that deduction is usually carried forward to the next year for most real estate investors. But for real estate agents, it's different. Because as a real estate agent or a real estate professional, in the eyes of the IRS, you can take that $15,000 deduction and then apply it to your real estate commissions or your active income. For example, let's say you made $70,000 in real estate commissions and you had $20,000 direct expenses before your rental property loss, which means your adjusted gross income would be $50,000. And at that level, you would be somewhere in the 22% tax bracket and you have taxable income of $50,000. But with your rental property loss, you would have another $15,000 deduction, which would then reduce your taxable income to $35,000 and put you in the 12% tax bracket, which will save you a lot of money in taxes. And this is huge because it is something that usually only real estate professionals can take advantage of. Plus, I didn't even mention that not only are you saving money on taxes, but you are building more wealth by owning an asset that is cash flowing and could appreciate in value over time. But I'm assuming as an agent, you already know that, right? Anyway, this is a great example of how the rich build wealth through taxes. Now, if you like this tip, make sure you click the like button for the YouTube algorithm and subscribe for more great videos. So now you might be wondering, what do I need to do to be seen as a real estate professional in the eyes of the IRS? Well, let's quickly talk about it with number 3. How do you qualify as a real estate professional? Now, I won't bore you with all the rules and details, but I want to leave you with 2 important notes. Okay, so number 1, the taxpayer must perform more than 750 hours of services during the tax year in real property trades or businesses which the taxpayer materially or actively participates in, which basically means that you need to be working in real estate for about 19 weeks if you work a typical 40-hour work week. So yeah, you need to be doing a lot of real estate for real. And then number 2, more than 1/2 of the professional services performed must be in real property trades or businesses. Now, examples of real property trades or businesses will be real estate leasing, okay? It would be real estate brokeraging, it would be real estate management, real estate development, it could be construction, acquisition, conversion, or other real estate rental property operations. Now, as long as you can satisfy those 2 rules, then you can be seen as a real estate professional in the eyes of the IRS and take real estate rental property losses against your active income. Okay, let's get into my top tax write-offs for real estate agents, with the first one being licenses and dues. Now, this one is kind of obvious, but I can't make a video without mentioning that you can write off all your monthly, quarterly, and annual fees associated with being a real estate professional. This would include stuff like your MLS dues, your NRA dues, your association dues, any of your brokerage fees or desk fees, and other membership fees that you may have. So definitely make sure that you don't overlook these and document them. Okay, moving along to number 5, I have advertising and marketing expenses. So branding and reputation are extremely important for realtors because it can help you gain more clients and close more deals. So advertising and marketing expenses such as signages for your open houses, your listing signs, your business cards, if you have a website, your website development and hosting fees. Of course, if you're advertising, you can deduct stuff like your ad expenses with Facebook ads or Google ads as well. Okay, all these can be deducted from your adjusted gross income and help you reduce your tax burden. Okay, the next tax deduction I have is the vehicle tax deduction. Many real estate agents must drive to meet with their clients and show properties, so they qualify for the tax vehicle deduction. Now, there are 2 ways to claim this deduction. First, you have the standard mileage deduction rate, which is the easiest method of the 2. So with the standard mileage deduction, what you do is you simply take a standard mileage rate that the IRS issues every year. And the standard mileage rate for 2022 is 58.5 cents per mile. So for example, if you drive 10,000 miles while conducting professional real estate activities in 2022, then you could deduct $5,850 from your income. The other method is the actual expense method, which is a little bit more complicated, but it gives you the ability to write off all your actual expenses associated with your vehicle. This could be things such as your car repairs, your gas or your electricity if you have an EV car, interest on your auto loans, depreciation, and that's just to name a few. And as I mentioned earlier, depreciation can have a huge impact on your income, and you can take depreciation on your vehicle. Now, with the actual expense method, it is important that you make sure you're tracking and documenting everything. So you want to be as organized as possible and try to have bookkeeping in place so you can actually file your tax return as accurately as possible. Now, the biggest question that I get is, okay, Sean, which method should I use? Well, of course, you want to take the method that gives you the biggest tax deduction. In general, if you drive a lot of miles, let's say you drive 15,000 miles every year as a real estate professional and your vehicle is less than $30,000, then the standard mileage deduction is enough because that gives you an $8,775 tax deduction, which may be difficult to achieve with the actual expense method. Okay, let's eat and talk about the next tax write-off, meal expenses. Everyone loves good food, right? Well, with this deduction, you can invite your clients out for lunch and write off 50% of the cost of the meal. But this doesn't only apply to your clients, okay? You can also invite your coworkers or your friends as long as the intent is for business. Now, if you do business meals very often, then I would recommend that you take notes with a few sentences on what was discussed during the meeting. That way you actually have proof just in case the IRS asks you some questions about all your business meals. Okay, next we have education, training, and travel expenses. If you're trying to become a top real estate agent, then you likely want to reinvest in yourself by learning from other successful agents across the country. Well, the good news is that you are allowed to write off any education and training expenses that allow you to become a better professional. This could be things such as paying for online courses, paying for professional coaching or consultation sessions. This could be buying real estate professional books. This could even be paying for Audible subscriptions and going to real estate conferences. And if the training takes place outside of your residing state, then you can also write off travel expenses. For example, if you are traveling to Las Vegas for a real estate professional conference, then you could deduct the airfare, the lodging, and the transportation associated with that business trip and conference. And it's okay if you mix some personal stuff with the business trip, just as long as the majority of your time is spent on business, you should be okay. So if there is a coach that you've been dying to learn from and you're making good money, let's say you're making $100,000 a year, and then you hire a real estate coach for $10,000 a year. Well, that will reduce your taxable income to $90,000, and you could save about $2,400 in taxes. So you could kind of look at hiring a coach at a 24% discount. Okay, let's move on to the next tax deduction, which is another favorite, the home office deduction. Now, I love the home office deduction because it's another one of those deductions that don't require you spend additional money. You're already paying for your mortgage or your rent, and this gives you an opportunity to take another deduction without spending more money. Now, it's important to note that you must be self-employed and the office must be a dedicated space in your home. Okay, that means you can't just set up a small desk in your bedroom and call that your office. I think some of the best places to set up a home office would be a spare bedroom that maybe you're not using. It could be using your basement or even a garage. Now, there are two ways to write off a home office. The simple method is to calculate the home office deduction by multiplying the square footage of the room by $5, which gives you a maximum deduction of $1,500. For example, if you had a 200 square foot room for your office, you would multiply that by $5 and arrive at a $1,000 deduction for your home office. The other method is to itemize all your costs related to your home and then multiply that by the percentage of the house that you are using for your office. This would include costs such as your mortgage interest or your rent, your property taxes, security system, insurance, etc. So let's say, for example, you had $36,000 as annual home costs and you had a 2,000 square foot house. And within that house, you had a home office that was 200 square feet. Well, the percentage of the office in this case would be 10%. So you would take 10% and multiply that by the $36,000 annual home cost to get your deduction. Moving on, we have expenses related to sales. So sometimes as realtors, you have some unusual expenses associated with closing deals. For example, you may decide to pay your clients appraisal fees or closing attorney fees just to make sure the deal gets done. Again, these types of expenses are very unusual to make on behalf of your client, but if you do decide to make them, then they can be written off at tax time. So some of these expenses would be open house expenses, it could be photography expenses, it could be staging fees, inspection fees, any concessions you decide to make, repairs, etc. Okay, all these can be easily overlooked, especially when agents are focusing on making the sale. But please remember to document these expenses so that you can write them off at tax time. Okay, moving along to the next tax write-off, I have employee and contractor expenses. So when you start becoming overwhelmed with all the day-to-day operations of your self-employed business, then it may be a good idea to start hiring some help. And for example, some agents have virtual assistants that help with more administrative related tasks such as data entry, managing schedules, posting on social media, filing paperwork, or updating their website with new listings. And you will be surprised that many of these virtual assistants are extremely skilled, but they don't cost as much as US labor. You can get a very skilled overseas virtual assistant for as low as $4 per hour. And the best part is they are able to save you time, help you work better, and you can write off their fees on your tax return. The next tax write-off you need to know about are gifts. So with this tax write-off, you can leave a lasting impression on your clients by giving them a gift. Like maybe you give a gift during the holidays to show your appreciation for your working relationship together. Or maybe you give a gift at the closing of a house, which of course is when most clients are super excited, right? So you can help celebrate with them with an awesome gift. Now I like using gifts as a good business strategy because of the reciprocity principle, which basically says that in many social situations, we pay back what we receive from others. So after giving a gift, it's the perfect time to ask for that review or ask for that video testimonial or ask for that referral that can help expand your client base. And of course, whatever you give could be considered to be a tax write-off, which is like getting something for 20 to 50% off depending on your tax bracket. All right, now since you made this far, I have one bonus tax strategy for you, which is to consider forming an LLC with an S Corp election. Okay, this tax strategy can save you tens of thousands of dollars because typically self-employed business owners must pay a 15.3% self-employment tax. But when you are set up as an S corporation, you can avoid some of those taxes. So let's break this down with an example. Let's say that you are not an S corp and you made $100,000 in net income, which is after all the deductions that we just talked about. This is net income. That would make your self-employment tax rate alone $15,300. That's $15,300 you have to pay to the IRS. Now, let's say you are an LLC and you elected to be taxed as an S Corp. Well, as an S Corp, you are now required to pay yourself a reasonable salary, which by the way, a reasonable salary for a real estate agent may be something like $42,000 per year. In this case, you would only pay 15.3% self-employment taxes on that $42,000 salary, which is $6,426 instead of paying $15,300, which reduces your tax burden by $8,874 simply by changing your tax entity, which is great. Okay, now this strategy is best reserved for established realtors or brokers who are making at least $70,000 in net income after deductions. And if that's you, then clearly you can see how this would help you out a ton. Now, if you want more unique tax strategies like this one, then make sure you click the link in the description and sign up for our tax planning program. Well, that's it for now. I have 2 more tax videos coming up next, so make sure you check those out if you haven't already, and I'll see you over there.